Okay. Good morning, good afternoon, and good evening, depending on where the world you are. So hello and welcome again to another installment of the Investor Essentials Workshop, brought to you by TechShake in partnership with SOSV. So hello everyone, I hope you're excited. We have a great session for you guys today where we will be talking about term sheets. And we have a very, very knowledgeable and experienced resource. So we have today Zena Wang from SOSV who will be talking to us about making the offer and everything that you want to learn about term sheets. So before we start, I just wanted to share, for the best experience possible for today, it would be great if you could set up your Zoom to be able to do a side-by-side mode. So we can actually try to do this for you automatically, but just in case it doesn't work, this is what you have to do. So all you need to do is go to your Zoom options and go to view options and look for side-by-side mode. Then you'll be able to see both the presenter and the presentation side by side. So this just gives us the best optimum Zoom experience. So I just wanted to also introduce myself. So hello, everyone. I am Artie Lopez from First Asia Venture Capital and co-founder of Brain Sparks, the first and only founder-focused incubator here in the Philippines. And we want to turn dreamers into founders. Now, Brain Sparks is actually part of a group of companies called Team Ignite, together with TechShake and Dentsu-X. And Team Ignite is the group that brings the largest international innovation conference in the Philippines today, also known as Ignite. And we hope that you guys have visited and joined us in one of the past 3 years. If not, we're looking forward to seeing you and having you over, possibly maybe in the near future. So I hope that you could join us. But for now, we are going to be doing a lot of online stuff. And together, like today, our partner TechShake is doing this event for everybody. And to tell us a little bit more about TechShake, I'd like to invite the co-founder. But before that, we'd like to thank our sponsor. Thank you so much, SOSV. Without them, this event would not have been possible. So SOSV has been a very, very big supporter of Ignite and of the TechShake events as well. So thank you so much, SOSV. Now we'd like to invite Paolo of TechShake to tell us a little bit more about the company and what they're working on right now. Hi, Paolo.
Hey, thanks, Artie. Thank you for the introduction. I also want to take this time to thank SOSV as well for supporting our event and also becoming a great resource for everyone who's attending today. Big thank you also to everyone who's attending our event and who continues to try and also help out the startup community regionally alongside TechShake. So just a brief background in case you don't know what TechShake is. We started out as a media company that covered the Philippine startup scene around 4 years ago. Since then, we've expanded out regionally and with the event, Ignite Innovation Conference event, as mentioned by Artie, and also in partnership with Brain Sparks, which Artie is also a part of. Since then, we've also expanded to other types of functions, such as investment advisory, business matching, and of course, these smaller events that we do specifically for different segments of the startup community, some for specifically for startups, and this one specifically for investors, right? So hopefully you guys get a value from this event. I hope that you also have fun and also learn something along the way. And with that, thanks and thank you and have fun in this event. Back to you, Artie.
Thank you so much, Paolo. And yes, you know, this is very exciting. I'm hoping to learn a lot together with everybody else in the audience. And thank you, TechShake, for organizing this. And thank you, SOSV, for supporting it. So as mentioned, we have a great speaker for today. We also are encouraging everybody in the audience to ask questions. So feel free to just type out the questions you have in Zoom and I'll call you out so that if you may speak up and actually ask your question directly to our speaker, that would be great. So we'd really love to see some interaction with the speaker today. Okay, guys? So hope hope your video ready or at least audio ready so that we could hear your questions straight from your mouth. So again, great speaker today. We'd like to introduce and welcome from SOSV, Zena Wang. Hi, good afternoon, Zena. How are you doing today?
Hello, everyone. Give me a second. I need to turn off the virtual background. I think I was trying to have it on. Okay, cool. So
sure, no problem.
Nope.
So let's try out that functionality. How's everybody doing? Why don't you try and type it out in the chat right now? Everybody having a good day? Okay. Zena, are you good to go?
Yeah, so I'm all ready. Thank you,
All right.
everyone, and thank you, RD and Paolo. I will try to make this as fun as possible, but it's gonna be a lot of, it's gonna be very legal heavy. So I'll try my best. Hopefully, no one will fall asleep during the workshop. Let me start sharing my screen here. Wait a minute. I think there's some technical issue here. Can everybody see my screen here?
Yep.
Okay, cool. So today's workshop is going to be about term sheets. So before we get into boring stuff, just really quick intro about SOSV. So we're a global venture capital firm focusing on really early stage investments. As you guys can see, we have offices in a lot of cities. So we have internet arms here in Asia. So I'm currently based in Shanghai. So we also have an office in Taipei. And in Shenzhen, we have our Hex accelerator, which is focusing on hardware. And then in EU and in US, we have other two accelerators on biotechnology. And we have another one on blockchain. So here's the rough structure. Sometimes people might get confused about what we are. So SOSV is our fund, and we invest through a bunch of different accelerators. So I'm from Mox and China accelerators. So cross-border internet, we look into consumer tech and to-B companies. And as I mentioned previously, we have hardware accelerators like biotech, and then blockchain-related accelerators as well. And then just to show you guys some numbers, we're pretty active. We're very early stage. We make a lot of investments every year. So currently the third most active VCs in the world, different rankings in different regions. We're the eighth most active VCs in Southeast Asia and of course in India. And then according to different sources, we're ranked differently in a lot of industries. So just get to today's topic. So what is a term sheet? It's a list of the terms of a round. So it can be a price round or it can be a convertible round. And the second question is binding or non-binding. So from my experiences, most of the term sheet are non-binding. I have seen a few sort of cases where the term sheet is a definitive agreement and it is actually binding, but it is really rare, because usually term sheet is a very brief document about a few key points. So at the end of the day, people actually need to have a more extensive document to list out all of the things that people want to have agreement on. And then it's usually offered by the lead investor to the investee, which is the company. And then usually, so one point that I would point out is, even though like a term sheet is non-binding, but throwing agreement out of the window is sort of not advisable behavior for any institutional VC. And it is actually a very small circle. So do not advise you to sort of give out a term sheet and then out of nowhere decided to withdraw a term sheet unless there's some anything weird coming up in a DD process. So usually a term sheet will be followed, it's a preliminary agreement. It will be followed by definitive agreements such as SPA, which is a share purchase agreement. And then will be also followed by a shareholders agreement. And then, so the most important things for the term sheet is usually if it's a price round, then people need to agree on the valuation, basically how much you want to pay for the company. And then along with that, you'll have sort of price per share, and then like how much in total that everyone will be purchasing. So that's total purchase amount. So those are the key terms. And then if you're doing a convertible round or a debt round, then everybody will be agreeing on the valuation cap, what's the discount, and then what are the payback terms, which means in how many years, if it's a debt round, then in how many years the company or the founders need to pay back the money. And if it's convertible, then there's no payback terms. Usually at the end of the maturity, then the convertible will be converted into shares. So next key thing on the term sheet will be a board seat. So usually there are two things that will be determined in this clause. It's either a board seat or a board observer seat. So what will be agreed in the definitive agreement is the right to appoint one seat. So it's either a board seat or a board observer seat. It's a right, not an obligation to do that. So if you have the right and then you want to appoint, if you're a VC or you're an angel investor, you can appoint yourself, or you can appoint someone from your organization or yourself to become one of the board members of the company. Usually there is some sort of shareholding requirement. So for you to keep the board seat, for example, you need to hold, let's say, 5% or 3% or 10%. It's up to the negotiation with the company and then other previous investors. So why this matters? So board seat, the reason why it's important is because at the end of the day, if you want to have more control over the company, then it's critical, because if you have board seat, then you have voting rights. So you can make any decision. You can make a decision on anything that needs board approval. And then I'll get to this in more detail in the next slide or so, I think. But it's very critical for corporate governance. And then who gets board seat? So usually it will be the lead investor who has the right to appoint one. So they have the right to appoint one board member, essentially. It is uncommon, but I have seen a couple of cases where a very early on, very active angel investor might get a board seat, but that's pretty rare. Usually it will be the lead investor, basically, who's putting the most money into the round. That's the person who is gonna get the board seat. And then board seat can shuffle, so sometimes you might lose your board seat, and then sometimes I've seen cases where people, they're angel investor, they're very busy with their own business, they don't have time to sort of devote into this company, so they will give away their board seat to other people. So you're sort of not sort of married to the company forever. So that's about board seat. And then reserve matters. Very important on a term sheet, because it will essentially will give some of the people, either the investor or the founder or a group of people, a veto rights on a lot of things that people or the company want to make a decision about. So usually there are two type of matters that either the board or the shareholders need to make decision. So there's corporate governance related stuff. So for example, like a budget, or like whether the company wants to give out dividends, what's the schedule for common share buyback and stuff like that. Usually, like anything related to this will be decided by the board, which is basically the majority of the board member needs to say yes. So it's always an odd number, 3 people on the board, 5 people on the board, or 7 people on the board. So you just need to get the majority vote in order for decision to be approved. And then the other set of matters is related to the company's capital structure. So for example, if the company wants to raise another round, which means they're gonna issue new shares. And if they want to amend their articles, if they want to approve a certain merger and acquisition, then matters like this will need to get approval from a bunch of shareholders. And then most of cases, it's the majority of the preferred shareholders. In some cases, based on agreement, they only need a majority approval from a certain share class, which means that will be, for example, Series A preferred shareholders or Series B preferred shareholders. So it's based on the agreement and what everybody agree upon. So for any, I guess, for the investors I guess entrepreneurs also in the audience, this is very important, because this will determine who has control on a lot of things in terms of company operation and then company fundraising activities. So the next step, we have some rights. So I list out 5. Most of them are investor-specific rights. So for example, preemptive right, which usually is given to the investor. So it gives you, this right gives investor, basically it is very close to an option. So it's your right but not obligation to purchase up to a certain percentage of the new share that will be issued in the next round. So it's pro rata based, so it's based on how much the percentage of your shareholding in a company at the moment. But it basically gives you the right, for example, currently you own 5% of the company, and then if you have preemptive right, that means in the next price round, you will have the right, but not obligation, to purchase up to 5% of the total new share issued in the next round. In practice, this is very, very valuable and important because you always want to invest in good companies, like popular companies that a lot of people want to put money in. So when there are a lot of people who want to put money into the company, then the company they have more negotiation power, so they can pick and choose the best terms that they want. And then in practice, in a lot of cases for my portfolio and also for the portfolios under our VC, some of the later stage companies can get super popular. It is very difficult for any newcomers, any new investors to even get into a round. And then sometimes they have to fight for investment quota, which in our terms is like begging to give the company the money. So it happens a lot, especially with, so in China, it happens so often these days, especially with some heated sectors. But for my deals and other deals that I've seen, sometimes it's so popular that it's very hard for any newcomers to get in. But if you have this rights, you can go tell the founder, I have this right, you have to give me 5% of the quota. And then it can be super valuable if you have that and the company is doing super good. A lot of people want to put money into them. And then the next up, the ROFR and the ROFO can be a little bit confusing for even for us because they look very similar. So and then the right can go both ways. So sometimes the founder might have it and sometimes the investor might have it. So when you're reading a term sheet, you need to pay attention to who actually has this right, because I've seen cases where both ways, basically. Sometimes the investor have it, and sometimes the founders of the company have the right. So I would just, because this is an investor workshop, I would just speak from the investor perspective. So if you have the right of refusal, that means when the founder of the company gets a third party offer. So for example, one of the company I invest in, they have an offer from a new investor who wants to put in a certain amount of money at a certain terms. So if you have right of first refusal, you can basically reject the deal and then say, you know what, so if the new investor is putting 2 million, you can be like, you know what, I'm gonna take the 2 million myself. So you can basically reject the deal and take up the deal yourself. So that's first of refusal. And then right of first offer happens in terms of timeline, happens slightly before that. So if you have right of first offer, then the founder needs to come to you and then tell you what's their plan. So they plan to raise how much or whatever so before they issue new shares or give any existing shares to other people. So for example, it's a secondary transaction, they're selling some of the old shares to a new investor, they have to offer that first to you. And then usually there's a response period time. So for example, it's 2 weeks or 3 weeks. And then you need to tell them whether you want to take it or not. The offer can expire. Usually it's 1 month or 2 months or so. It depends on, it's what's agreed in the company's document. So the next step is co-sale rights. Sometimes it can be also called as tag-along rights. So basically, if you have this, then if other investors or other shareholders can be investors or the founder, if they're selling their shares, then proportionally you can sell a certain portion of your shares. So that gives you some sort of a liquidity. If somebody else is trying to make an early exit, you can sell some of your shares as well. That's convenient for some of the investors and make sure everybody is treated fairly. And then drag along is a tricky one. So the drag along rights, it can benefit the company, it can benefit the investor. It can benefit some investor, but will put other investors' position in danger. So usually there are two things that will be listed out in the drag along section on the term sheet. What's the percentage, what's the threshold in order to make a drag, and then what's the valuation agreement. So for example, in the clause, it says if there's 75% of approval from the preferred shareholders, then, and if the valuation is over a certain number, let's say 100 million, then basically the 75% agreed shareholder can drag other shareholder to sell the company. So if there's this clause, and if you're a major investor, you're a leading investor, you can basically force other minority investors to also sell their shares to basically ensure that acquisition can happen. So this is actually a pretty common clause in later stage deals. Sometimes the lead investor, for example, their later stage VCs, they have exit pressure, or their PE firm, they have exit pressure. So they will usually list this out and make sure they can drag everybody to sell the company and make sure they can have a successful exit. So I guess for the audience here, if you're an angel investor or you think you're early stage, which means most of the case you will be the minority shareholder, you will be not as powerful as the later stage ones, to pay attention to this and make sure you are okay with the terms, because what you don't want to see is somebody drag you to sell the company when you think the return is not so good, and you actually want the company to stay in the business to grow organically for a few more years. Okay, cool. And then, so the next step, we have liquidation preferences. So it's, as I said, liquidation preferences, and then it's most of the time it's only given to the preferred shareholders. So two types of liquidation preferences. One is participating, and then the other one is non-participating. I'll start with the non-participating one because it's slightly worse than the previous one. So if it's non-participating, that means if there's a liquidity event, so the company is selling their assets or whatever, they're getting acquired by somebody, they will get a stack of assets that either they get from the acquirer or wherever they get, they liquidate their assets, they have money. So they will basically distribute the money to the preferred shareholders, usually the investors who have preferred shares, and then the investors will get their share, they get their investment back. And then I wrote here, market standard is 1x. So for example, the investor put in 1 million, and then they will get 1 million back first. And then if it is non-participating, then that will be it. And then every investor, preferred shareholders, they get their money back. And then the remaining of the asset will be distributed to common shareholders. But if it is participating, liquidation preferences, 1x participating, that means after the investor get their 1 million back, then whatever they're holding right now can be viewed as converted to common share basis, and then they will join the common shareholders and get distribution again. So it's a much better terms for the VCs if they want to try to ensure they're getting their money back. So this is sort of like a insurance for the VCs. And then the market standard is 1x because I mostly do deals in Southeast Asia and South Asia. This is sort of the market standard number I have seen, but in China, actually sometimes it can go up to 1.5x or 2x. It is on the predatory side because you're basically screwing over the founders. If there's a liquidation, and then you're getting 2x your money back, then you're not actually taking any risk. And then at the end of the day, usually the founders will get nothing. It is pretty predatory, but so far I have I haven't seen any cases like this in Indonesia, for example, or in India. So it is by market. So you need to basically make sure you understand that the market you are investing in and what is the market standard, because you don't want to go out there and then be this asshole, like everybody hates you, because essentially it's a very small circle and you don't want to be that like super predatory one that no one wants to work with you. And then, so this is sort of exception I wrote here. It changes based on every market and then the risk level. So the reason why that it's high here in China, sometimes it can get to like 1.5% early on back in the days. It's because it's highly risky. People don't know how the market is going to change. And then there are a lot of regulation changes here in China. So people, especially for foreign investors, they don't know what's going to happen to their money. So that's why they're asking for more protection over their investment. So this because of the high risk associated with the investment. And then next up, we have anti-dilution. So this protects the investor in the case of a down round. So for example, you paid $1 for a share in a company, like say 2 years ago, and then unfortunately the company is not doing too well for 2 years, and then they're running out of money. Because they're not doing too well, they don't have great tractions. Their valuation is actually lower than what was the valuation 2 years ago. So unfortunately, they need to do a down round, which means they're selling their company at a portion of their company at a cheaper price. So an anti-dilution protection for the investor in the previous round will be so basically the company will issue you more shares, so that the de facto price you pay for the shares is a broad-based weighted average, which is sort of like an average price across the company's basically fundraising history. So for example, if you pay $1 and then right now they're doing 50 cents, and then they did a bunch of calculation, and then the average price for the share in the company is, let's say, 75 cents. So you're gonna get more shares to basically compensate your loss. So this is also market standard. There's another one called full ratchet, which means you're basically getting the 50 cents, and then they're basically giving you, so if you have 100 shares, they need to give you 200. They need to give you 100 shares more. This is extremely rare, and I haven't seen any cases where any investor is asking for full ratchet anti-dilution protection. So again, for VC friends or angel investor friends, just keep in mind that what is the market standard? You don't want to go out and say, hey, I want a full ratchet, because it's very rare. I haven't seen any cases like that. So the market standard is always broad-based weighted average. And then redemption rates, it's a tricky one. Sometimes you don't even have it in your own market. It's not in it's not market standard practice for VCs. I've seen this in China and India specifically. Haven't seen these rates in other countries, in other markets. So basically, the investor can get their money back if there's no exit or IPO within certain years. It is pre-agreed. Sometimes you can get this done, or you can solve the issue by negotiation or whatever you want to talk with between the founders and the investors. But it can be very dangerous for the founders. Of course, if you're an investor, then this basically make your venture capital investment a risk-free investment. You can get your money back regardless if there's no IPO or exits within 5 years or so. This is a very tricky one. If you see it in terms of if you're an entrepreneur, to be very careful. And then if you're an investor, if you want to protect your investment if you want to do that, you can use this. But as I said, it's not common practice in most of the countries that I have been investing in. And then Esop investing, this is a very interesting one for a lot of the investors, because this is a highly common situations where an early stage investor can get screwed over. So this mostly happens when the founder, for example, the company is getting a new term sheet from a new VC. Let's say they're doing a Series A round of 20 million. And then there's this very powerful tier 1 VC, very aggressive on the terms. And then they look at the cap table and notice that there's only 5% ESOP ESOP reserve, so it's not allocated. They have 5% ESOP reserve, and then they will be like, okay, I don't think you have enough ESOP. Like, you're gonna hire more people, and then we don't want you to spend that high salary on those talents. So you can pay them less, but then you need to give them ESOP shares. So we want you guys to increase the ESOP from 5% to 10%. And then if the cap table, if the ESOP is gonna increase from 5 to 15, then everybody else on the cap table already. So that's before the round. Right? So if you're on the cap table already, which means you're an existing investor, and then there's an increase of ESOP from 5% to 10%, then your shareholding will be diluted a lot. You need to pay attention to this one, mostly for early stage investors. And then usually, so what happens in reality is, in response to this, is there's some sort of restriction on ESOP increase, which means it's related. It's mostly in the reserve matters I mentioned previously. So basically, if a company wants to increase ESOP, then they have to get approval from either the board members, or they need to get it from like the majority of shareholders. So there's some protection on the investor side, but again, you need to pay attention to this because it can get very tricky, and then you might get screwed over pretty badly later on in the history of the company's fundraising. So usually it's common VCs will require a certain percentage of ESOP before investment for early stage deals. If the company is at Series A or Series B stage, usually they will request 10%, but it's based on how many shares that has not be allocated to the employees. So it's unallocated ESOP. And then we have founder investing. Essentially, you don't want to invest in a company and then the founder leaves in 1 month or 2 months, and then the company is like worthless. So the standard is usually for 4 years. So basically, the founders will not get their shares if they leave, let's say, 1 month after investment. Their shares will get vested over the time. So usually it's 25% each year for 4 years. And then if they leave early, so for example, the founder, they want to leave, let's say 2 years after investment, then only 50% of their shares are vested, and then the rest of the shares, unvested shares, will be sold back to the company. So this is more to protect the investor and make sure that they invest in a company where when you do early stage investment, you're not only investing in the company, you're also investing in the founder, because it's a lot of the early stage deals, they don't really have that many tractions. So we value a lot about the founders. And then what you don't want to see is they want to leave and start some other new businesses. So this is to protect the investor and make sure that founders is devoting 100% of their time to run the business, not doing anything else. So that's ESOP. And vesting, of course, it's always subject to negotiation. So I've seen different starting point for vesting. Sometimes the founders they want to have more freedom, so maybe it can be 3-year vesting, or they want to count the starting point for vesting a bit earlier. That happens, and then it's based on it's a case by case situation. And then next up, so we have a term on exclusivity. Sometimes we call it no shop clause, which means that when you so in practice, right, you give a term sheet to a company. I say, I want to invest in you, and then the company can, if you don't have this clause in it, what will happen 100%, I can guarantee you, what will happen 100% is the company will take the term sheet, and then they go around in their VC friends or whatever the VCs are talking to. They're gonna go around and then they will call VCB and say, hey, so we have this term from this company. Do you want to join around, or do you want to give us better terms? Otherwise, we're just gonna go with them. So it creates a sense of FOMO, and then essentially any type of term sheet will give the company some sort of negotiating power that they can go around and basically shop a better deal. So that will 100% happen if you don't have this clause. So if you have this clause in, that means that they cannot shop, basically solicit any other offers for a certain period of time. It can be 2 months, it can be 3 months. So basically during this period of time, the company is not allowed to sort of go out and ask for a new deal. So this is very important, because what you don't want to see is you're interested in a company, you've done all of the hard work on due diligence, you know the company, really like them, you spend a lot of time, a lot of legal resources, your team's time to look into their data, you like them, you give them a term sheet, and then you forget to put this clause in. Right, and then so they take your term sheet, they go around and they get a better deal from other VCs. That's what you don't want to see. Very important to put into the term sheet. And essentially, but then as I said, it's valid only for a certain period of time, so you cannot have this forever. So usually it's 60 to 90 days on the signing date of the term sheet, and then afterwards, if the time has expired, then they can go out and solicit other deals. So on the investor side, you also need to close around as soon as possible. Okay, so make an offer. So I'm just gonna briefly go through the logistics of actually making an offer. So this is sort of the like the standard practice. Of course, in reality, it will always change. You will have accident, incidents. It will change. The dynamic might change. It might get super complicated if there are other investors trying to get into the round as well. So usually the first step is the lead investor will offer a term sheet. So basically what that means is they will set the terms for a round. Most of the cases, it's the lead investor's responsibility to set the terms. And if they set the terms, then they are actually the one doing most of the work. And in most of the cases, they will hire a lawyer and they will try to sort of help out with the coordination and make sure everybody is happy with the terms. And there's a lot of back and forth going on. I have seen cases where lead investor usually is the one putting the largest check. But in practice, I have seen cases where an investor is not the lead investor, but they want to set the terms, and then the lead investor is actually okay with it. Because as I've said, it's a lot of work on the lead investor side to actually make sure the round is happening. So sometimes they get lazy, they're okay with the terms that the other investor is putting out, so they would just let the other investor, quote unquote, set the terms for a round. And then usually after the term sheet is out, then what happen in reality is the company, the founder, will circulate the term sheet with all of the existing investors, because essentially the company needs the buy-in from existing investors. So this will happen. They will circulate the term sheet among all of the existing investors, and then things can get pretty heated afterwards, because you have three parties here. One is the founders. They want to protect their own rights. They want to have as much control as possible they have over the company. And then you have existing investors who essentially have taken up more risk by investing in the company earlier when the traction is not there, let's say. So it's more risky for them, and they want to get compensated for taking more risk, essentially. And then also protecting their existing rights. And then also you have new investors who's just coming, they're putting a lot of money. They might be putting more money than everybody else had in the history of the company. So they're putting more money, they have more power, they want to get more rights for themselves. And things can get pretty heated during this stage. And then this is also why we always advise our entrepreneurs to budget enough time if you want to do a price round, because of the negotiation that's going on. So we usually, if we can close a round from time when you get a term sheet to money in the bank stage, if you can do it in 6 months, that's actually pretty smooth and successful. I've seen it get dragged to 9 months or even a year because of the negotiation that needs to go in. Like a very common case is the new investors, they want to get rid of some of the existing rights that existing investors have, and then existing investors are not okay with it. So this is a very typical deadlock. Usually somebody has to sort of step back, and then it's usually like a pretty shitty situation for the founder, because he's basically waiting for everybody to have like everybody to be happy with the deal while the company is still burning money, and then they're kind of towards the end of their runway. So it's wasting time for the founders. That's a typical this is a sort of like a typical situation where it will take up a lot of time for everybody to be happy with the terms. And then also on the controls, sometimes the new investors want to have more control over the company, and then the founders and the existing founders will not be happy. So essentially there are a lot of interests involved, and then a lot of communication involved to make sure that everybody is okay-ish with the deal. So after everybody is happy, I put in parentheses who has a say here, is because sometimes you don't. So for example, if the board needs to approve something, then it's the board members who have a say in this. And then sometimes a lot of the early stage angel investors, they're such a small shareholder, so nobody actually cares about what they think or whatever. So most of the time they just take the deal and sign it. But if everybody else, so for example, if you're an angel investor but has a lot of shares in the company, a lot of interest in the company, you have a say, or you're an institutional investor, then if everybody is happy, then we will sign a term sheet. And then after the term sheet is signed, then people will start the actual paperwork, which is definitive agreements, as I mentioned earlier. So it's share purchase agreements, which is basically listing out the terms, the price evaluation, all that stuff, transactional related stuff, like the investor need to wire money within 10 days or whatever. So it's on the transactional stuff. And then there's another set of documents called shareholders agreement, which is basically listing out the rights that everyone has in the company. And then I prepared this slide because I think some of the audience are actually thinking about making an angel investment themselves. So I prepared this slide for potential angel investors. So generally, an angel investor, you don't have the resources, so you're just by yourself. You don't have the manpower. You don't have a team to do due diligence for you. You don't have your own legal team to negotiate a term for you. So most likely, if you want to do an angel investor, of course, you need to have the network. You need to have access to the deal. So for example, if you have VC friends and you have money, and then the VC friends might reach out to you and then just sending you a nice deal that you want to invest in. But at the end of the day, you will be tag along a term sheet offered by an institutional investors, just because they have more resource to negotiate the terms, and they can actually make decision in terms of whether they want to invest in company or not, because they have more manpower to do the work. Or alternatively, if you're looking into early stage VC investments, you can do through angel investment platforms. There are a lot of those platforms out there. Before you commit to anyone, you need to ask around and make sure this is a reputable platform, and then make sure that they're getting good deals. So they're not only raising money for shitty deals. To pay attention to this, sometimes those platforms are called crowdfunding platforms. There are a lot of them out there. You need to do your own homework before you commit to any of the platforms. And then the last one, actually I've seen this more often these days. This is basically you negotiate and invest as an angel group. So it's basically you guys come and basically form a group, and then there will be like a representative go out and then talk to the companies. In this case, usually the angels will have sort of more negotiating power. You guys can look at the deal and then give the company sort of feedback and push on some terms. So by sort of investing as a group, you will have more negotiation power. And then the other benefit of this is it will give you access to better companies, because sometimes if a company is good enough, they might not take small check size as for example, 25K or 10K. 10K is mostly a no-no for the deals I have seen. 25K is okay. And then 50K US dollar, it's all in US dollar. 50K is an okay check size if you want to do the investment by yourself. But if you don't want to take that much risk, you just want to do 10 or 25, then in a lot of cases, the company will not even take your money because of the paperwork that's involved. So for example, if you think about this, if there are like 10 people like you, everyone's putting 10K, then that's just 100K. But then in terms of the logistics, when company is actually closing the deal, then somebody actually has to reach out to every single one of you and get a signature. And then it's not only just for the price round, it happens for anything in the future of the company when they need every shareholder's signature. So if you're coming into a group and then there's a representative, usually that one person will be the signing party. So basically he or she is gonna represent you. And then usually founders are more open to this format because they just need to talk to one person, and then you basically just saying okay to like having this person represent you as an investor in the company. So that's all for my presentation. So I'll open the floor to Q&A if anybody in the audience have any questions. I have a QR code here. So this is for Mox, which is the site that I'm working for. We do, as I mentioned earlier, early stage investments into internet companies. We're sector agnostic, focused mostly on to-be companies. So if you're interested in what we're doing or in general, we can scan a QR code. And then if you scroll down the page, there is a sign-up bar for our newsletter. So in case you want to stay in touch. And then I have my email address here. You can ask me if you have any questions after the workshop.
Okay, thank you so much, Zena. And as mentioned, just take a photo of the QR code and you can get access into SOSV's website. So you could be part of their newsletter and get updated on what's happening with them. But we do have a few questions from the audience, Zena, so I hope you don't mind. One of them is regarding to Esop. So I'm not sure, how do you say this, NA or NA? Would you like to speak up and ask your question to Zena?
Hi, can you guys hear me?
Yes, we can.
Yeah, hi. So that's Neil. Well, my question was more around the average ESOP pool at the seed stage. I've heard varying ranges from sort of 5% to 20%. What tends to be the average at the seed stage?
Yeah, so hi Neil. So I think what you were saying is definitely correct. I have seen sort of various ranges of ESOP. I would say the standard is 10%, but it also depends on how many ESOP shares that the company has sort of given out. So when you're looking at a cap table, you need to make sure that you get this info right. So for example, if a company, they have 10% ESOP on cap table, but then actually 5% of it has been allocated. For example, they hire a very senior person like the CTO, and then they agree to give this person 5%. So this is actually allocated ESOP already. So you need to make sure that the ESOP pool on the cap table is actually allocated. Of course, in general, if a company is early stage, they need to reserve more ESOP. I would say 10% is a good benchmark. If the company is below that, then like 99% of the time when they're raising the next round, the new investor will ask them to increase the ESOP pool. And then, as I mentioned earlier, unfortunately, most of very likely the early investor, existing investors, their shareholding will get diluted.
Sure, thanks.
And then, yeah, I agree. Andrew actually has a very good point where it's a very great presentation. He's actually asking, would you be open to sharing the presentation with the audience?
That I need to check with our back office and see whether we're okay to disclose the information.
All right, got it. And then we will let the audience know as well. We have a new question from an anonymous attendee, so I guess I'll be the one to bring it up. How do you negotiate if an investor wants 2 times liquidation preference or participating?
So So I'll put it this way. It's very difficult to give sort of like a black and white answer in terms of how you can actually get the deal. But as I mentioned, it's your reputation. I'm not sure whether the audience is from institution or angel investor. In any case, as I mentioned, the VC circle is actually a very tiny community. And if you've been in a circle long enough, you know, like everybody knows each other. So your reputation is very important. And then if the market standard is 1x, if you want to insist 2x, most likely you will not get the deal because as I mentioned, so there are different interest parties in a negotiation. So I'll just sort of give you an example and explain why you might not get the deal. Because if you come in, let's say Series B round, and you want to get 2x, but then the early investors in the company, the Series A ones, they all have 1x. So they're much worse off than you are. And then if there's a liquidation event, let's say you put in 2 million, and then let's say the company get 4 million in after the liquidation, right? If you have 2x, then you're gonna take away all of the money, and then all of the Series A investor will get nothing. So if you want to go ahead and then ask for something that's different from the market standard practice, and then different from what company has been offering to existing or earlier investors, the first pushback you're gonna get is from the existing investors. So it's gonna be very difficult for you to get the deal. And then if at the end of the day, the early investors, if they have enough say in the company, then you need their approval to say okay to the deal. Most likely, if it has been 1x and then you are asking for 2x, then most likely the earlier investment will just kill the deal, and then they will tell the company to find another investor. And then in terms of participating and non-participating, I've seen both cases. Most of the time, participating is the standard, but it might vary based on which markets you're investing in. It is standard, and then I think this is the best thing for you to do is look at what the company has been offering to like early investors. If the company has been giving out participating, then of course you can get it. But if they're offering non-participating and you want to ask for it, very similarly, you might get pushback from early investors. So everything is subject to negotiation. And the one last thing is, if you're putting a lot of money, like a shit ton of money, and you're saving the company, if they don't take your money, they're gonna die, then you have a lot of negotiation power. And if that's the case, you can go ahead and ask for terms you want.
Thank you. Actually, it's a very comprehensive answer, because I think the question can come from either, we're not sure where the point of view is coming from, if it's from a founder point of view, or if it's from an investor who wants those preferences, or if it's an investor who has to deal with a fellow investor who wants those preferences. And I think that you've answered from all points of view. We have another question, anonymous again. What are the usual or standard consequences if an investee does something not approved or not allowed by the investor? And how is that usually documented in the terms?
Investor, something not approved or not allowed by the investor. So I guess the standard answer will be the company is gonna get sued. So if say the founder did something that he or she is not allowed to do, then for example, I'll just give an example. If in the document or in your company articles, it says you're not supposed to say like spend $1 million on food and beverages for your company, and then you did that, then technically the investors can sue you because you did what you're not supposed to do according to documents. In reality, whether they're gonna sue you or they're not gonna sue you, based on how serious the wrongdoing is, there is cost of bringing cases to court. So they might sue you, they might not sue you. So, but again, to make sure everybody is happy-ish and then you don't have any sort of hostile situation going on in your company or among your shareholders, try your best to follow what is written in the document, and do not do anything that's gonna upset other people.
Okay, thank you. I hope that answers your question to the anonymous asker. Another one. Is there a noticeable difference between how Western VCs craft term sheets versus Asian VCs?
Yes and no. I think most of the difference, of course, there's some difference from geolocations and stuff. But I think most of the case is based on how developed a country is. And fundamentally, sometimes when you're seeing a lot of like aggressive terms, as I mentioned earlier, in China back in days, even now it's not very common for you to see like 2x liquidation preferences. Back in the days, it's common people might ask for 1.5%, 1.5x, and then that's because the market is not so developed and there are more risk associated with early stage VC investment. And then that's why sometimes when you compare Western VCs, term sheet, and Asian VCs, you might think the Western VCs are more lenient. They're not asking for aggressive stuff like 2x liquidation preferences, or they're asking for like super harsh redemption rights. Let's say you don't have exit in 3 years, they're gonna ask you to pay them back. It's rare because the market is developed, and then the risk is lower. And then the other I guess the other variable is how the overall VC industry is developed. So a lot of the aggressive terms happen when the market is not so developed. People can do whatever they want, but then if the market, so for example, in US, let's say the VC industry has been up and running for so many years, there are certain norms, norms of behavior, norms of terms there, which will make it, I guess, more friendly to the founders. But then if you're like in a nascent market where everybody is like doing what they want, everybody's trying to figure things out, then it is more likely for you to get in, more likely for the entrepreneurs to see aggressive terms, and then the investors are only comfortable about putting money in when they have more protection for them.
Yes, definitely agree. Recently came from an experience with fundraising from a YC company. And yes, the US investors seemed very, very lenient. And actually, to your point, you were mentioning earlier that in your experience, angel investors don't startups don't usually take in less than 25,000. I think you said, I think you said 10,000 is a no, right? And the reason is it's because it's difficult, to the paperwork to chase. But I have noticed in the US that they do lower 10,000, 5,000 to 5. And the way that they deal with this is they actually use automation. So there's so many new platforms like captable.io, Clerky, what all of these that automates all of these paperwork. So maybe that's why they're able to do that here. But we haven't caught up yet in Asia.
Yeah, it's the overall sort of the VC early stage investment scene in US. A lot, I guess, more people are comfortable with angel investment. It's all or nothing for them. So the company might die, they will get nothing, or they can have 10x or 200x or have 1,000x from a deal.
Yeah. Okay, so far that's questions. I actually do have a personal question, if you don't mind. So this is in a more simple or early experience. Have you actually had that experience where it's the startup that actually gives you the term sheet at the start?
Yeah, that's that has happened as well. So sometimes the startup can give out term sheets, and then most of the time, if the terms are okay, everybody agrees to it. Then the investor might take it as well. At the end of the day, term sheet means a lot more work. And sometimes the VC is lazy or whatever; they don't want to actually do the work for them. So as an entrepreneur, if you have a term sheet you're happy with and you want to give it to the investor, you can certainly do that, and then the investor will accept it, and then most likely they will sort of push back on some of the terms, so that's subject to negotiation.
Okay, so optics wise, that's okay for you as a VC.
Yeah, that's fine.
All right. How about for anti-dilution rights? What do you think is the point of view of the industry? I guess how do they view it, and when is it the right time to discuss that?
You mean if you want to do a down round?
Or if you're discussing anti-dilution in preparation for a down round, is this something that you can discuss at the in a seed stage, or is it only for like a Series A investment?
I guess you have to discuss it with the investor when you have to. So if your company is dying or it's not going too well, then you have to raise money at not so favorable terms. Then you have to do it to keep the company up and running. And I mean, it's definitely a very tough conversation you need to have with the investors. But as investors, we've seen cases like this a lot actually. Because shit happens and then company might not not everyone will be growing like 10x or 20x or 50x a year. So it happens. It's just a very difficult conversation you need to have with the investors. And then, as I said, mostly it's broad-based weighted average. So essentially, you're just gonna need to give the investor more shares. Sometimes the investor might ask for like warrants. We've seen that as well. So if the idea is the same, they're putting money, they pay more for what they pay more, they pay more expensive price, and now you're offering the shares at a lower price, so they want to get compensated a little bit.
Copy. All right. Are there any other questions from the audience? It was a great presentation and a great talk. But if anybody else has any questions, we have maybe one more. Anyone? Okay, seems like we are good to go. So thank you so much, Zena. Appreciate it. And again, thank you to SOSV. So let me just do a little bit of housekeeping before we go. So we want to thank again the audience and our speaker, and of course our partner for joining us today. Thank you so much. And we'd like to invite also everybody else. If you want to join this series, I hope you're following us and we have your emails. But if not, please follow the social media accounts of TechShake and Ignite, and you'll get updated on the next events. Next event will be on May 4th. And it will be actually on Clubhouse, and we'll be talking about behind the scenes in the VC world. It's going to be with RJ of Monks Hill Ventures, and of course, it's will be hosted by Paulo Rentero of TechShake. So we hope you could join us there. Check out the app. And then another event will be on May 24th, and that will be the next part of this series. And we're gonna update you guys on what the topic and the speaker will be. So I hope you keep posted. Okay, and again, if you need anything else from the group, please don't hesitate to contact Rick or Kotaro-san of TechShake. And if there are any other questions that you would like to send over to Zena, or if there are any other issues that you would have, or like what Zena also mentioned earlier today, if you're a potential angel investor and you want to start investing in startups and you don't know what to do, or you want to learn some more, please feel free to contact the group, and they will help you. They will help you get guided to the right direction. Okay, so thank you very much, everybody, and thank you again, Zena. Thank you, SOSV, and I hope everybody has a great day. So thank you very much. Good morning, good evening, and good night.
Thanks, Zena.
Thanks.
Bye.
Thank you so much, guys. Thank you so much. Thank you, everyone.
Thanks, everyone. Take care.
Thank you. Bye-bye.